What ethical issues arise from agricultural hedging? Imagine a farmer trying to protect their crops from falling prices or a big trading firm betting on future market moves. Hedging is a tool used to manage risk, but it can also raise some serious ethical questions. When farmers or investors use financial contracts like futures to lock in prices, it's meant to create stability. But sometimes, it can lead to unfair practices. Large players with deep pockets might manipulate markets by placing big bets that influence prices, making it harder for smaller farmers to compete. This can create a sense of unfairness, especially when small farms lack the resources to hedge effectively. Another issue is access. Hedging strategies are often easier for big farms because they have more money and resources. Smaller or mid-sized farms might not have the same ability to use these tools, which can widen the gap between large and small agricultural operations. This raises questions about fairness and whether everyone has equal chances to protect their income. There's also a fine line between hedging and speculation. Hedging is supposed to help farmers and producers manage risk, but sometimes traders use it just to make quick profits from price swings. When this happens, it can cause prices to become more volatile, which affects everyone from consumers to farmers. This kind of activity can undermine market stability and lead to higher food prices, which is a concern for society as a whole. Transparency is another ethical concern. If market participants withhold important information about pests, weather, or crop yields to gain an advantage in hedging, it can harm others. Honest sharing of information helps keep the market fair and functioning smoothly. Environmental and social issues also come into play. If hedging encourages overproduction or monoculture farming to maximize profits, it can harm the environment. Practices like overusing land or chemicals can lead to soil degradation and loss of biodiversity, which affects local communities and future generations. Regulatory compliance is essential too. When traders or investors bypass rules or exploit loopholes to gain an edge, it damages trust in the market. Fair rules and honest behavior are key to maintaining confidence in farmland investments and agricultural markets. To handle these ethical issues, farmers and investors should be transparent about their activities, avoid manipulative tactics, and support fair access to hedging tools for smaller farms. They should also consider the environmental and social impacts of their decisions, making sure they follow all regulations. This way, risk management can be done responsibly, helping to keep agricultural markets fair and sustainable for everyone involved.